Imagine that you are the head of the Federal Reserve. The year is 2008, and a huge real estate bubble has just burst. A wave of bankruptcies is sweeping through the financial system. The stock market is falling. Your phone is ringing off the hook. Politicians and CEOs are begging you to do something. In an act of desperation, you cut the Fed's funds rate down to zero and flood the system with liquidity. For a short while it works. The newly created money stops the bleeding and calms the markets down. But you know that this is not a permanent solution. Your advisors are warning you that the US economy is suffering from structural problems. The population is aging. The debt load is increasing. Growth is slowing down. These deflationary pressures are putting the fiat monetary system in jeopardy. Its ability to expand was very convenient during good times, but during bad times it could just as easily contract, pushing the US economy into a deep recession and undermining its position as the leading superpower. You have two alternatives. The responsible one is to let the chips fall where they may. Allow the big banks to fail and their shareholders to bear the losses. Force the federal government to reduce its spending and balance the budget. Let the American people tighten their belt and settle for a lower standard of living. Reform the monetary system by introducing sound money again. This course of action would certainly be painful and extremely unpopular, but in the long run it would yield a more stable and equitable economy which is good for everyone and not just the super rich. The second alternative is to initiate another cycle of boom and bust. By printing dollars and purchasing bonds, you can suppress long-term interest rates. This will encourage corporations to borrow more money and hire more workers. This will also help real estate prices recover and generate a wealth effect, which will send the public on a shopping spree. This way, you can create the semblance of growth and extend the life of the dollar by a few more years. Since you are a spineless and irresponsible person, you choose the latter. In order to confuse the public, you call your program by the obscure name quantitative easing. You lie to the congressmen who are questioning you, telling them that this move is temporary and reversible. Finally, your plan is implemented, and it's an instant success. With the money you just printed, you bail out your banker friends, taking all the toxic mortgages off their hands. Very quickly, they become profitable again and can afford to pay generous bonuses to their people. The treasuries that you purchase allow the federal government to borrow trillions of dollars on the cheap and spend like a drunken sailor. A significant amount of this new money finds its way to the stock market, and the leading indexes are rallying once again. Although millions have lost their homes and the unemployment rate is still high, a celebration begins on Wall Street, which will last for many years to come. You know full well that your policy favors the rich at the expense of the poor, and that it will lead to extreme inequality. But you don't care, because you belong to the elite. Politicians love you. Everyone thinks you're a genius, and even Time magazine chose you as their Person of the Year. There's just one small problem with your plan, your advisors warn you. The problem is gold. Since the launch of quantitative easing, its price has almost doubled. Due to the rampant money printing, people are afraid of inflation. We have to do something about it, or people will start dumping the dollar, and all our efforts will be in vain. Let's call our friends at the bank, you suggest. We just bailed them out, and they owe us a favor. They will surely know what to do. The bankers come to a meeting, and they do not disappoint. They have an idea how to control the price of gold. All they need to do is to dump a huge amount of futures contracts on the commodity exchange, preferably late at night, when trading is thin. This will scare off the public and convince them that investing in gold is a bad idea. But won't that put you at risk, you ask? In order to pull this off, you need to have a huge short position. No problem, they say. Once the price falls enough, we will buy back the gold at a cheaper price. We can do that again and again until no one wants to invest in gold anymore. But isn't that illegal, you wonder? Yes, it is illegal, the bankers admit. But perhaps you can have a little chat with your friends at the CFTC and ask them to look the other way. Sure, you say. What are friends for? And this is how you achieve what no central bank has been able to do in the past: print money out of thin air while preventing the price of commodities from rising. This is selective inflation, which affects the price of stocks, bonds, and real estate, but not gold, oil, or wheat. And since financial assets are not counted in the CPI, you can pretend that the inflation doesn't exist. For Wall Street investors, this is sheer heaven. Their portfolios are constantly growing, while their cost of living remains low. But for the average working person, this is hell on earth, because the price of the house that they want to buy keeps rising, while the value of the commodities they produce stays the same, and their salary is steadily getting eroded. No matter how hard they work, they can never keep up with the rate at which financial assets are appreciating. For precious metals investors, this is especially painful. Even though logic dictates that their price is supposed to rise together with the ever-increasing money supply, an invisible hand prevents it from happening time and time again. Years have passed. Thanks to selective inflation, the dollar has managed to maintain its global reserve status. Fueled by the newly printed money, the stock market has risen to unimaginable heights, while the price of commodities has languished. But in the aftermath of the COVID-19 pandemic, something has snapped. For the first time in over a decade, some of that liquidity has spilled into the commodity market, generating a spike in the CPI. Thus far, the Federal Reserve has managed to convince everyone that this is just a temporary phenomenon, and that they can extinguish it by raising rates. But if the trust in the central bank ever wanes, inflation could come back with a vengeance. The imbalance between commodities and all other sectors is so great that we could be facing a devastating correction. The scenario I've just described is nothing but pure speculation. I have no proof that the Federal Reserve is colluding with the big banks in order to suppress the price of precious metals, and by extension, the price of all other commodities. And yet, I have no other explanation as to why the price of gold is barely at its 2011 high and the price of silver is less than half of its 2011 high, in spite of all the dollars that have been created since then. If that is truly the case, and the price of gold and silver has been artificially suppressed for over a decade, then they have a lot of catching up to do. Thank you for listening to the Silver Hermit podcast. Please subscribe to this channel and share it with your friends and family. Hit the bell icon to be notified whenever I release a new video. Remember, I am not a licensed financial advisor. This video is intended for general informational purposes only and should not be regarded as investment advice. Before taking any investment decision, please consult with a professional financial advisor who may assess your personal investment objectives and needs.